Hey guys, how are you all doing? It's Rohan here. So the SEC chairman Gary Gensler has revealed that the regulator will use all available tools to bring crypto platforms into compliance with its rules. In addition, the SEC chief said proof of reserves is neither a full accounting of the assets and liabilities of a company, nor does it satisfy segregation of customer funds under the securities laws. Before proceeding, if we have not met before, very welcome to my channel, and in this channel you will find analysis and opinion daily on crypto, macroeconomy and global investment scenario in general. Let's start. So where was SEC chief when Sam Bankman-Fried was funneling FTX customers' funds to his Alameda research trading house to finance risky bets and a lavish lifestyle? That FTX had not registered with the SEC does not let Mr. Gensler off the hook. For months, he has claimed to have authority over crypto and warned about self-dealing at their exchanges. So why didn't he investigate the company that would have given SEC records of FTX's sloppy bookkeeping and perhaps its alleged fraud? In September 2021, Mr. Gensler rejected major industry players' contentions that he needed congressional authorization to regulate crypto products. So he said to Washington Post that we have robust authorities at SEC and we are going to use them. And also he said that we will be the cop on the beat bringing those enforcement actions. And the Commission indeed had brought those enforcement actions, but strangely not against FTX. Mr. Gensler claimed that all cryptocurrencies except Bitcoin and a few others that he owns specify are securities subject to SEC regulation and thus require the same robust investor disclosures as stocks and bonds. He has also claimed jurisdiction over crypto lending platforms and trading exchanges on the premise that digital assets are securities. Probably he considered his progressive regulatory agenda a higher priority, including a climate rule requiring public companies to disclose their greenhouse gas emission. Recently, an SEC Inspector General report in October warned that Mr. Gensler's aggressive rulemaking agenda was overwhelming staff and diverting resources from investor protection. It also likely that Mr. Bankman-Fried's $36 million in donation to Democratic parties brought him some political protection. So I wonder if Mr. Gensler was waiting for a crypto disaster, that is FTX, to serve as the impetus for Congress to grant him the authority to regulate the industry aggressively. And this is not the first time customer funds went missing on Mr. Gensler's watch. In 2011, more than $1 billion disappeared from the failed MF Global brokerage firm run by former Democratic New Jersey Governor Mr. John Curzon. The CME Future Exchange reported that MF Global hadn't been complying with federal rules on segregating client funds. Mr. Gensler then was the chairman of CFTC, or Commodity Futures Trading Commission, and was MF Global's primary regulator. And he and Mr. Curzon helped write the 2002 Sarbanes-Oxley Act tightening securities regulation in the wake of the Enron fraud. So anyway, the point being that at that time also, Mr. Gensler was unable to protect customer funds. So let's look at some interesting tweets in this regard. Stuart Alderoty, the attorney from Ripple, he tweets, the SEC admits that FTX customer assets were used to bail out BlockFi, where those customer assets funneled to the SEC to make payment on the $100 million SEC BlockFi settlement. Did the SEC bother to conduct any due diligence on the source of those funds? So this tweet has generated a lot of attention. So let's look at this particular situation, what he is talking about. That is this comment from Stuart Alderoty. Alright, this article, Ripple's General Counsel, SEC finally admits FTX customers' assets were used to bail out BlockFi. Stuart Alderoty has made an important discovery in the SEC's recently filed charges against FTX and Alameda Research execs. According to Alderoty, the Securities and Exchange Commission recently admitted that FTX and Alameda Research executives Sam Bankman-Fried and Caroline Ellison used customer assets to bail out embattled cryptocurrency lender BlockFi. on or about June 21, 2022, after giving 250 million line of revolving credit to BlockFi, a global crypto financial service company, to provide the company with access to capital to ease liquidity concern. Bankman-Fried tweeted, "We take our duty seriously to protect the digital asset ecosystem and its customers." So, Elderoti raises vital questions here, that following the SEC's comment, Elderoti raised some question that the agency needs to answer. Elderoti asked if FTX customer assets were funneled to the Securities and Exchange Commission to make payment on the 100 million BlockFi SEC settlement. So in case you are not very familiar with the context here, that's the story behind that. Recall that earlier this year, SEC charged BlockFi with failing to register its cryptocurrency lending product. The SEC also charged the crypto lending platform with violating the registration provision of the Investment Companies Act 1940. To settle with the SEC, BlockFi agreed to pay 100 million in penalty, seize the sales of the lending product, and register the business within the provision of the Investment Companies Act. In June, FTX agreed to provide the crypto lender, that is to BlockFi, with $400 million of revolving credit facility with an option to buy the platform at a maximum of $240 million. Following the collapse of FTX last month, BlockFi filed for Chapter 11 bankruptcy protection, citing its exposure to FTX. And that's exactly where this question from Elderoti is coming, that did SEC do any due diligence on where from FTX getting this money? Is this the customer's money, a customer's assets that they are just funneling to SEC for this settlement? And that's a serious question indeed. And last month, Minnesota Representative Thomas Earl Emmer alleged that the meetings between Bankman-Fried and Gensler were part of efforts by the agency to give FTX special treatment over other crypto firms. So with all those actions coming from SEC and Gary Gensler, I just want to go through this article written by Rosalind Layton. She is a pretty famous journalist in this aspect, and it was published in Forbes. SEC punishing progress while rewarding confusion. This article very brilliantly summarizes all the actions coming from SEC recently against crypto market in general, or any innovative part of the investment community in general. So the SEC has trafficked in some high visibility, low value enforcements like the overhyped fine against Kim Kardashian. Regulators sometimes use headline grabbing to send political messages and to demonstrate their value to stakeholders. The agency has been on an enforcement tear of late, eager to bash any and all crypto assets, even those which play by its rules. While SEC Chairman Gensler tells innovators to come in and talk to us to find out what the rules are, companies risk being hammered for doing so, something no one knew is wrong. Sadly, this egregious effort has deterred the innovations that investors want. Look at Grayscale, Ripple, Robinhood, Coinbase. So, moving further, the well-established crypto participants are in good faith trying to engage with the staff. For reasons none of us understand, that process is too slow and cumbersome and has yet to bear fruit. It needs to move faster for sure. Innovations that investors want. Look at Grayscale, Ripple, Robinhood, Coinbase. And then under this section, the SEC should work with industry to get it right. The SEC should, however, work with the players trying to get it right in advance of a substantial offering. In other contexts, market participants often engage with the staff through well-established process of no action letters before engaging in some activity. A no action letter provides some assurance that if the advisor does precisely what is laid out to the staff, the activity would not result in an enforcement action. The well-established crypto participants are in good faith trying to engage with the staff. For reasons none of us understand, that process is too slow and cumbersome and has yet to bear fruit. It needs to move faster for sure. Markets move at lightning speed, regulators at snail's pace. There will never be meaningful clarity or protection unless the SEC does the minimum to publish rules in advance. This does not exist presently. So the article mentioned the story of Grayscale. That's a fantastic story to learn what went wrong with the SEC. So Grayscale Investment is the world's largest digital currency asset manager with 15 billion in assets under management. It holds the tokens underlying the investment vehicle in cold storage or offline, making it easier for investors to buy, sell, store, and safekeeping of digital assets outside of exchanges like the fraud-ridden FTX. As Grayscale developed its Grayscale Bitcoin Trust or GBTC to a spot exchange traded fund or ETF, it followed the SEC's guidance and instruction. Yet, the SEC rejected Grayscale's application, denying the use of the Commodity Futures Trading Commission or CFTC methodology it had earlier recommended. The SEC subsequently noted that its decision is consistent with every other spot Bitcoin ETF application it receives. Hence, this summer, Grayscale sued SEC, claiming the SEC's inconsistent treatment of Grayscale products was arbitrary, discriminatory, and in excess of the Commission's statutory authority. It also argued that the test the SEC has applied to Bitcoin-related ETFs and only Bitcoin-related ETFs is flawed and has been inconsistently applied with a special harshness to spot Bitcoin ETFs. Multiple amici briefs support Grayscale's views. So Grayscale goes on explaining, although Bitcoin may be relatively new asset, the legal issues here is straightforward. In 2021 and 2022, the SEC approved several Bitcoin future ETFs, but repeatedly rejected ETFs that hold Bitcoin directly or spot Bitcoin ETFs, including Grayscale's application to convert GBTC. The brief highlights that Bitcoin futures and spot Bitcoin both generate their price based on overlapping indices. So the spot price of Bitcoin in each product is subject to the same risk and protection. That stark arbitrariness cannot be justified or reconciled with the Commission's mandate to treat like assets alike. Rather, it can be only understood as a substantive judgment on the merits of a spot Bitcoin investment, the kind of substantive judgment that is outside of Commission's authority. That's the position, that's the explanation or a brief from Grayscale. The SEC's arguments were so weak that Ripple's attorneys rapidly turned the table on the regulator in court and put the SEC itself on trial. By the end of the arguments, after 2 years of litigation, an unprecedented number of amicus briefs had poured in against the SEC's legal theory, including from more than 75,000 XRP holders whom the agency was supposedly protecting. So in the end, Ripple's case will likely have exposed the SEC's regulation by enforcement strategy as a flimsy attempt at expanding its turf rather than concern over investor protection. And that pretty much wraps up this video. If you liked it, do smash the like button and also don't forget to subscribe. See you in the next one.